Good morning, everyone. My name is Cole Pearson, President of Investment Solutions here at OneAscent. Welcome to our market update for Q3 2024. Thank you all for spending a part of your morning with us. We've been doing this call now for just over 5 years, every quarter. Many of you have been with us for a majority of that. So thank you for spending your time with us this morning. I'm going to open us with a quick word of prayer, and then we'll jump into our time for today. Let's pray. Father God, thank you for today. Thank you for a new day. Thank you for the chance to talk about what's going on in the world, Lord. There is a lot of brokenness, a lot of division, a lot of pain in the world. And Lord, we get to talk today about money and what's affecting markets, ultimately because we believe that you are in control. You are the owner, and we are not. We are stewards. So Lord, I pray that as we talk today about investing in the markets, that we remember where our hope is. Our hope is not in our balances or ourselves, but it's in you, Lord. So thank you for this time. Thank you for the chance to talk about the markets. I pray that you be with our speakers as we speak, our listeners as they listen, and we pray that you get the honor and the glory. We ask all this in your perfect Son's name. Amen. All right. Well, again, welcome to our Q3 market update call. My name is Cole Pearson, President of Investment Solutions. I'll be your host this morning. We'll be joined with Nathan Willis, our Director of Portfolio Strategy, to talk about what's going on in the markets, what happened in the first and second quarter, the outlook for the balance of the year. This call is a quarterly call. We have it every quarter on the third Tuesday of the quarter. So you can go ahead and mark your calendars for the next one in September. But we look forward to sharing information with you on a quarterly basis. If you have questions throughout the call, you can submit those by email. You can send those to info@oneascent.com, and we'll be monitoring that. You're also welcome to use the features built into the webinar here, either the chat or the question Q&A box. So before we jump into our market review, I wanted to share just quickly again about why we exist here at OneAscent. We focus on what we call values-based investing. And our approach to values-based investing includes our 3 E's. When we think about our values and investing, first step is to eliminate from our universe those companies whose products or practices are causing harm. Things like abortion or pornography, predatory lending, severe ethics controversies. Those are the things that we spend a fair amount of time in getting data on to make sure that we're not investing in a way that doesn't align with our values. But secondly, we've got to evaluate. We are, in fact, investing. And so we need to make sure that the companies we're investing in, the managers that we own, that they meet our investment objectives. What that looks like for an equity investor may look different for someone who is investing in fixed income. But there's got to be that strong evaluation component to our process, and there is. But finally, for us, when we think about values-based investing, it is about avoiding the things that are causing harm, but it also is about moving towards those things that are making the world a better place. And so we call that elevate. We want to elevate the companies that make the world a better place. We want to see those in our portfolios. We want to see our portfolios grow because those companies are bringing blessing and flourishing to their customers, to their employees, and to society at large. So that's our approach. The way that we do that, we have spent a fair amount of time in our data and our systems to do this with excellence. This is our Elevate tool. It's a software tool that we've built, a proprietary values-based screening platform. It incorporates real-time data so that we can analyze individual companies and managers for eligibility in the portfolio. We do this on your behalf. Some quick stats about the Elevate tool. We look at 8 different eliminate issues across 47 different sub-issues, subcategories within that. We're able to look at 70,000 different issuers or companies who issue either an equity security or a debt security. And in total, that's about 3.9 million data points, unique data points that are coming in and refreshing either on a nightly basis or on a weekly basis. So that's our approach and how we do that. If that's something that's interesting to you, if you're exploring it or kicking the tires, you want to learn more about values-based investing, we'd love to share about that with you. You can get a free assessment. If you visit our website at oneascent.com, you can select Analyze My Investments, that button there on the right. And what it'll take you to is a quick little tool. It'll ask you a few questions, ask you what are the things that you want to avoid, what are the things that you want to elevate, and ways that we can get in contact with you to take a look at your own portfolio. So please take us up on that. That is a free offer. We love to talk about values-based investing and to help share the data that we've built with you all. So that's really the core of what we do is values-based investing, but we are in fact investing in the markets today. And so today we're delighted to have Nathan Willis with us. Nathan is our Director of Portfolio Strategy. He leads our Asset Allocation Committee as well as our Manager Selection Committee, and is going to give us an update on what's happened in the third quarter and what we're looking at for the balance of the year. So Nathan, thanks for joining us.
Thanks, Cole. It's great to be here with you. We're going to follow our typical pattern for our quarterly reviews, in that we're going to do a review of what happened in the markets in the second quarter. And we're going to give a little historical context as well, because I think it's important in terms of thinking about the outlook. We're going to go through our navigator process and formulate our investment outlook. And then finally, we're going to answer the question you may have, which is, what actions should I take in my portfolio right now? So let's start off with returns in the second quarter. This is a very, very interesting return chart, in that the first bar there, the S&P 500, was up over 4%, while the mid-cap and small-cap indexes were down a bunch. In fact, this is the largest difference between large and small stocks in about 10 years. There have only been 10 years, or excuse me, there have been 3 quarters in the last 10 years when large cap stocks were up, but small cap stocks were down. And the other 2 instances, it was just a little bit. Large was up a little bit, small was down a little bit. So this is a real stark reminder of how narrow this market has been. Very much driven by narrow leadership of the U.S. mega cap, artificial intelligence driven stocks. But it's not only the U.S. In the international, you didn't make any money unless you owned Taiwan, India, and China. And not only that, not just Taiwan, but almost all of the returns in Taiwan, a large portion of them were from Taiwan Semiconductor. Taiwan Semi is an AI play. They make chips that NVIDIA uses and others. But outside of those 3 small pieces of the international markets, you didn't really make any money. Bonds didn't do a whole lot in the quarter. They adjusted to lower inflation and a slowing economy. So let's broaden out and look at the last year. You would have been very happy with your returns over the last year. In Russell mid-cap and small-cap stocks, you earned 12% and 10%. You earned double digits in internationally emerging stocks. You earned a little bit in investment-grade bonds, but you earned 10% in high-yield bonds. You'd have been very happy with that if you never saw the S&P 500 returns, because the S&P 500 left everything in the dust, up 25%. And so it's frustrating because we believe in being diversified, and so we're exposed to a lot of areas that didn't capture those returns that the S&P 500 did. But it's important to understand a discipline and how to handle that. And it's important to understand what these returns mean for the future. All right, so let's look at what this looks like for the future. One note to make, strong high yield bonds reflect really, really strong risk appetite. So the high yield bond market, in a sense, doesn't think we're going to have a recession. So file that one away for later in the presentation. But let's go back even farther than a year and talk about what has kind of been driving things for the last couple of years. And it's inflation. This is a chart of inflation, the CPI, and you can see that it spiked after COVID because of all the COVID financial pressures that were put on by government stimulus programs. But inflation kind of went amok, and the Fed had to, after the fact, come in and raise rates. And then what that did was that really destroyed the stock market. And why did that destroy the stock market so much? One of the reasons is that this was the harshest Fed rate hiking cycle in history, harshest in terms of how quick they did it and how much they raised rates, 5.25% from 0 to 5.25%, and just over a little more than a year. And so that really, really took the wind out of the sails in 2022. So thinking about where do we go from here, what we're going to do now is kind of start from the bottom of 2022, and see what's happened since then and what that may mean for going forward. So from the bottom of the market, this is a chart from September 30th of 2022. The low was within a week or so of that. The S&P is up 56%, which is fantastic. Unfortunately, most sectors lagged. You can see here at the bottom, utilities and real estate only made 5% or so. In fact, the only thing that you could have done that really, really made strong returns was to own these AI-driven names. So technology more than doubled. and communications more than doubled. And this was all because of the mega cap 7 names that really carried the day. So why has tech been on such a tear? And will it continue, or will the market broaden out? What will cause the rest of the market to pick up steam? And so valuations is one. We've talked a lot about the S&P 500 being expensive and a lot of other areas of the market being a little more cheap, but they need a catalyst. And fortunately, right now, we have a catalyst, we think. And so let's talk about that. This is a chart of earnings growth every quarter, the year-over-year change in earnings. But what we've done here is we've split out the mega cap 7 in gold and the rest of the S&P 500 in blue. And so if you look here, we tell a really good story. The market went on a tear in 2021 and really kind of came back in 2022. And that was reflective of kind of an earnings recession that happened for the broad market. So you can see the whole market had negative earnings growth in March of 2023. Okay, but what happened in March of 2023? Two things. Number one, we had a banking crisis with Silicon Valley Bank that has kind of caused the rest of the economy to stagnate a little bit. But also, AI began to be a huge driver of earnings, and we see it in the June earnings numbers. So the second quarter of 2023, the rest of the market still lost money or still made less money year over year, but you saw this trend begin of the Magnificent Seven just really going on a tear based upon AI. And so that really drove returns in 2023, kind of left the rest of the market behind. But where are we now? We're in the second quarter of 2024. And for the first time, the rest of the market is actually contributing positive year-over-year earnings growth. So AI is still doing really well. It's going to be a big trend. But more importantly, the key factor going forward is that the rest of the S&P 500 is actually starting to grow earnings again. And in fact, if I showed you mid-cap and small cap, you would have seen a much larger drop, and you're seeing a much bigger increase in 2024 and 2025 earnings. So we think earnings are going to broaden, and that should allow the market returns to broaden as well. So where does this leave us? I think there's a few issues for the second half of the year that we need to consider. First of all, inflation. We talked about inflation. It's coming down, and this should allow the Fed to cut rates fairly soon. Secondary, the market has really been hoping for a soft landing. And so a soft landing is kind of a Goldilocks situation where the economy needs to slow, but not too much. And so we're seeing signs of economic slowing, but there's a few signals that we may be in for a recession. And so we're watching those very closely. One of those signals relates to the consumer. And so the consumer is beginning to show a little bit of stress. And we'll talk about that in a couple different areas. But earnings are good. We expect them to broaden, and that should be a positive driver going forward. And so the question, what should I do in my portfolio? Our answer is to follow a disciplined process. So let's shift and follow our process and see what it tells us. Our process is to look at 4 things. Our Navigator Outlook focuses on the economy, market technicals, consumer and investor sentiment, and then finally, market valuation. So let's do a highlight or two from each section and see what it tells us about the future. So we already talked about inflation, so I'm not going to dwell on it too much, but the PCE, which is the one in blue, is the one that the Fed prefers, and it is coming down to where they needed to be, giving them the ability to lower rates. I talked a little bit about a soft landing and hoping to avoid recession. This chart here illustrates how difficult that is. This is the Citigroup Economic Surprise Index. So it takes every economic data release and it says, is it better or worse than what the market was expecting? And what you've seen is all through 2023, the data was coming in better than expected. Stocks were on a tear. Well, that has changed. And in the second quarter, the data has started coming in worse than expected. And the month of June really kind of, puts a stamp on that. So we need this to slow, but we don't want the data to be too bad such that we'll go into a recession, because those can kind of be a self-reinforcing theme. When the data slows, it tends to snowball a little bit. Stock market. We are happy in some parts of the stock market, but the technicals overall are neutral. And so one of the ways we're kind of neutral here is that we see a little bit of a slowing of momentum in the stock market. So this chart shows you that the S&P 500 is in a really, really strong uptrend. But the middle here, the gold, shows you that the percentage of the S&P 500 members making new highs is declining. And so what this tells us is that there's a little bit of a softening of momentum, and we're probably due for a pullback. We haven't had a really significant pullback this year, and we normally have one. We shouldn't be afraid of it, but we may be expecting one at some point here, just to kind of be prepared. The other chink in the armor we talked about, in addition to slowing economic data, is the consumer. And this takes a little bit of a different take on the consumer, because it talks about consumer confidence. Consumer confidence is really, really important, because your confidence in the economy affects your spending patterns tremendously. And so the blue line here is the present situation, how you feel about the economy right now. But the gold line is your expectations for the next 6 months. And you can see the two lines, deviate a lot. And what this does is helps give us, I think, an expectation for what might happen going forward. A little bit like inflation expectations. When people expect prices to go up, they may accelerate a purchase, buy something quicker so that you don't have the price go up on you, and that actually kind of causes more inflation. Expectations can function the same way. If consumers are really worried about the future, they may slow their spending today. And so this kind of tells us that, maybe there's a little bit that we should be cautious. The idea that we're gonna have a soft landing and there's really no chance of a recession is probably not accurate. We need to be prepared for a recession if one happens, even though it may not be our base case. That being said, there's one really good positive. Even though valuation overall is neutral, everything outside of U.S. large cap stocks is really, really attractive. One thing I will point out on this call today is small cap stocks. That is the bluish gray line at the bottom here. This is a 25-year chart. And small cap stocks are right at their average valuations for that whole 25-year period. And the last time large caps were at such a significant premium to small caps was 2021. But before that, the last time was the tech bubble. And after the tech bubble burst, small cap stocks did fantastic relative to large cap stocks. So we think the broad market, including small caps and international stocks, is really, really attractively valued. And so we're overall pretty much positive on the market. So let's bring it all back together in kind of one picture. We are positive about the economy, but negative on consumer sentiment and investor sentiment. And valuation and technicals are neutral. So this leads us to our portfolio positioning and our recommendations to you of what you should do in your portfolio. First of all, we want to kind of anchor in our investment philosophy. So first of all, we are values-based. We're very long-term, and we are globally diversified. So we're not going to worry about short-term fluctuations, and we want to position for the long term. So what we're doing in portfolios today, or what we've done recently, is we have trimmed our high-yield bond allocation. High-yield bonds have performed very, very well. I noted that high-yield bonds were up 10% over the last year, and that reflects that the high-yield market doesn't believe we're going to have a recession. We cut our high-yield position in half, just kind of out of caution. It's probably the sensible thing to do. We shifted from high-yield bonds to investment-grade bonds. We're still earning a really good return, but we're a little bit less exposed to that risk. Secondarily, we kind of increased a risk asset a little bit, which is we increased our international small and mid-cap allocation. We've talked a lot about the fact that we are overweight international and overweight small and mid-cap stocks. So this is just kind of a little bit of a further expression of that. And so these are the two key things we've done recently in our portfolios. So let's shift a little bit and talk about our overall asset allocation. These are our 5 risk-based portfolios, and we generally focus on our moderate portfolio, our 60% stock portfolio. You can see here that we have 18.5% in large cap, but more than that in small and mid, and then a healthy allocation to developed and emerging market stocks right now. The other thing to point out is near the bottom there, our high yield allocation is just 1.8%. In that moderate portfolio, that was shifted to corporate bonds. We're very, very positive about the market. We're fully invested, but we're cautious. So with that note, I will turn it back to Cole to see if we have any questions.
Excellent. Thank you, Nathan. Again, if you have questions, we'll leave this here on the slide. You can contact us at info@oneascent.com or use the chat feature or the Q&A box there in your Zoom. We do have a few that have come in by email. Nathan, obviously we're in an election cycle with the events that happened over the weekend with former President Trump, candidate Trump. How does the election change kind of your outlook, especially with his odds seeming to have increased coming out of the weekend? What does that do to your view on the markets?
Yeah, well, there's one way it doesn't change things at all, and there's one way it changes them a lot. First, the way it doesn't change things is this is one of my extra slides that didn't make it in, but what this is this is the budget surplus, or rather the deficit. And you can see we only had a surplus, a couple of years. That was during Bill Clinton, but all these deficits show, and the red bars show a recession. And so if you look here, we have moderate spending during a recession. But then when we had the financial crisis, we had to kind of come with a bazooka to kind of save the financial system. Unfortunately, that today is kind of normal now. So we've never had the kind of deficit spending we have today outside of a recession or a crisis or a war. And that's really bad for the long term. But in the short term, that actually supports the economy. And there is no difference, or very little difference, without offending everybody, between Democrats and Republicans on actual spending. So that's one thing that I will say. The one thing I think that does change is that it's pretty clear to most economists that Trump is a little bit more pro-growth, but also, even more importantly, probably going to be more protectionist, which will include a lot of things, tariffs that will kind of increase inflation. So inflation probably goes up higher on a Trump presidency, or is at risk of going higher relative to a Biden presidency.
You started our time. If I could follow up on that real quick, Nathan, for myself. You started our time today talking about inflation, Fed raising, and then the impact it had on the S&P. If inflation were to go higher, I know you don't have your crystal ball, but what would that mean for markets?
Yeah, it could mean a repeat of 2022, where in 2022 inflation spiked, and the key things that hurt were the higher PE names. So tech did very, very poor. Mid-cap growth did very, very poor. So one of the other things we've done in our portfolio, it's a little bit more under the surface, is we have kind of reduced our aggressiveness of our small and mid-cap allocations. We kind of went from reduce some from kind of a little bit of a more turbocharged growth manager to someone that's a little bit more core. And so just kind of trying to make a subtle move that will protect us if inflation does spike. Inflation's not really the base case right now, but we're kind of want to protect against it a little bit.
Okay, great. Thanks, Nathan. We have a question in from a listener. Says Nathan, you shared a lot of information, a lot of great information. Several times, some green things, some red things, but what are you most worried about? And perhaps maybe you can answer for our firm. What are we as a firm most kind of monitoring or concerned about?
Well, everything, because that's our job. We have to be worried about everything, but not paralyzed by anything. But the thing that I'm probably most worried about is a recession, because soft landings are very, very, very difficult. There's really only been one in the last 50 years or so. Usually soft landings become hard landings. And so if this incredible deficit spending plus Fed Governor Powell kind of turning on the rate cut machine aggressively, those may be able to keep us out of a recession, but that's the thing I'm a little worried about. I didn't talk a lot about it on the consumer expectations slide, but we're seeing two chinks in the armor in terms of the consumer. So one is credit card debt, and the other is auto loans. And those are two areas that are kind of indicative of the weaker part of the consumer economy. Both of those are seeing a spike in 90-day and 30-day delinquencies. So as we see those spike, sometimes those can be an early warning of the economy. So I would say a recession is certainly not unavoidable, but it is probably more likely than the market thinks it is.
Okay, thank you. We have another question here in the chat, actually. We've talked a fair amount about the stock market, but with interest rates going up, money market yields, cash, bonds, can you talk a little bit about fixed income, cash, equivalents? What's your outlook on more income-oriented assets?
Yeah, so better than it's been for the last 15 or 20 years is my outlook. One of the key things about bonds is that they are very, very math driven. And so your forward returns relate a ton to the current yield you're getting. Okay. And so intermediate corporate bonds are earning 5% or more right now. And so that's a really, really good expectation for what you might earn over the next 5 or 10 years in bonds. High yield bonds are yielding more like 7%. If we don't have a recession, high yield bonds are going to do fantastic. And 7% is really close to what you're going to earn, what we think you're likely to earn in the stock market over the next 10 years, but you don't have anywhere near that kind of risk because you're protected by a lot of other investors under you. So I'm actually very, very excited about bonds. They're not a very sexy thing, but they're very, very important. And they're going to play a role for the next 5 or 10 years that they haven't really played in the last 5 or 10 or 15 even, and that they're going to be a really important part of your portfolio. So don't abandon bonds now.
Great. All right. Well, that's all the questions that we have today. We try to keep these calls to roughly 30 minutes, so we're right on time. If you have other questions, please, again, email us, info@oneascent.com. We'd love to follow up one-on-one. But we have lots of resources, not only this call, which will make a replay available. We have resources about our allocations, fact sheets on our various products, commentary. Nathan puts out a weekly commentary, a few brief thoughts on the markets, as well as a longer form monthly. If you'd like to follow along with those, you can get in touch with us in all the normal channels. But we want to thank you again for spending a part of your time with us this morning. We value that, and I really appreciate your interest in what we're doing and in values-based investing. Again, I mentioned at the start of our call, if you'd like to learn more about that as well, you can go to our website and select the free assessment there. So thank you for your time today. Hope you have a great rest of your day. And that'll conclude our call today. God bless.